I'm Fred McClimans, and on this Samadhi Partners video brief, I am joined by John Freeman and Guaylon Arnic. Gentlemen.
Hey, Fred. How you doing?
Hey, Fred. How you doing?
Doing well. On today's brief, let's run through some of the recent earning announcements from some of the companies in the Samadhi Partners portfolio. And before we do that, though, let me just remind everybody, this is a newsletter, a video newsletter. It is for informational and entertainment purposes only. We are not offering or implying any type of investment advice. So with that, gentlemen, busy earnings season here. Let's kick it off with Ceva. The ticker is a CEVA in our portfolio. They are about a 739 million market cap. They had revenue of 72.7 million in the most recent quarter. They just reported, I think, a little over a week ago.
No, that was
21 million.
That's full year. Yeah, that's got to be full year. No, that's okay. So here's the thing. So I love Ceva. Ceva is one of my favorite ideas in the semiconductor space. It's what they do is they license intellectual property so that other chip companies can design and build chips. So what their area of specialty is are DSPs, digital signal processors. The business model, though, is very similar to ARM, which recently got purchased by SoftBank from Japan for, I believe, it was about 35, almost 40% premium, and so it was a pretty spectacular buyout. And Ceva, I think, has sort of benefited from that. The stock has benefited from that, kind of the halo effect there. But the fundamentals of this business are great. So what they do is they license to basically all of the baseband, cellular baseband processor chip vendors, except Qualcomm and MediaTek. And so over time, Qualcomm and MediaTek are going to lose share in 3G and 4G. That's just a natural sort of part of the progression. And so what's going to happen with Ceva is about half of their revenue right now is from 2G phones, producing, basically 2 to 3 cents per phone, to 3G phones where they get 5 cents a phone, to 4G phones where they get 10 cents a phone. So just a royalty rate increase should drive significant revenue growth, and they've got areas of upside. For example, Vision, they have a Vision DSP core, basically a blueprint for how to build a digital signal processing into your chips. And also for so that by the way has an automotive for the intelligent autonomous driving applications and all that kind of stuff, but also things like gesture recognition, emotion recognition, facial recognition, all these kinds of things from the from sort of the Internet of Things and that whole sort of trend. So they're benefiting from a lot of great secular trends. It's a great business model. Operating margins around 18% now, but as we know from ARM, these operating margins could easily go right up in this licensing model. You go easily into the 30s and 40s. So that drives, we think the revenue growth, is probably going to be in the 20s for the next 5 years. So that drives, because of the operating leverage expansion, you'll get EPS growth that could be 40 to 50% annually for the next 5 years. So our weighted average expected return, the weighted average of all 5 different scenarios that we've modeled out, comes to just under 30% annual return for the next 5 years. So it's got one of the highest expected returns of any company in the portfolio. But it is a small company, so there's always that kind of small company risk, I suppose. On the other side, though, it's got a very healthy balance sheet with there's a 239 million market cap from yesterday's close, but they've got 150 million of that in net cash. So, I always like that. I always like that situation when you've got more than 10 or 15% of a company's market cap is in net cash.
Yeah, they're
750, right?
Yeah, it's 730 or 700.
As I hear you
739 million.
Ceva, and specifically as it relates to Qualcomm, from a strategic standpoint, why wouldn't Qualcomm just buy these guys?
Well, they could if they wanted to snuff them out, and maybe gain access to growth markets such as because obviously if they buy them they would just put a kibosh on the DSP licensing business because they wouldn't want to be licensing to their own competitors. I suppose they would buy it. They might want to buy it for the intellectual property that revolves around the image processing and the facial recognition and all of that stuff. But they would have to do it in such a way that, if they made that acquisition, it would be, okay, we're snuffing out competition here. We're hindering competition rather than doing it for growth, growth opportunities. And now that Qualcomm's got a lot of other issues on the table right now, so I'm not sure that Ceva is their biggest problem, but perhaps down the road.
Who are Ceva's prime clients?
Well, like I said, the baseband customers that are not Qualcomm or MediaTek. So that's Intel, Broadcom, Spreadtrum, I believe is probably their biggest customer, the biggest handset customer anyway. That's a Chinese fabless chip supplier to most of the Chinese handset vendors, and ST Ericsson.
Okay.
But I'm thinking from a cost standpoint, they're going to lose a lot more than $750 million over the next 3-4 years as we migrate to 2 or 3G,
right.
4G.
Like in terms of like market share loss.
Absolutely.
Yeah. No,
Yeah. And it's not a U.S.-based company, right?
It is. It is a U.S.-based company, but they have most of their R&D in Israel. So, to your point, I think it could be an interesting strategic move on Qualcomm's part. So there is that ticket. However, you also have to look at it from the optics and regulation perspective, because Qualcomm's fighting a lot of regulatory battles too. People thinking that their licensing model is egregious and also is in conflict with their chip. The chip part of their business, that they tie those two things together. If you pay our royalty, then we'll give you a break on the chips that we sell you, that kind of thing. So buying a company like Ceva, I'm not sure would help them in terms of that optics relative to, say, the EU. They don't really have a problem in the States, but they do have a problem in the EU with that, and they have a problem in Korea and Japan.
They should spin off the chip business and buy Ceva and just have a
one big licensing business. Yeah, that's not a bad idea.
A lot of value in that kind of a business model.
Yeah, but I think there's a lot of that has been bandied around. Been talked about and kicked around with Qualcomm for a long time. But I think Qualcomm actually kind of does like, even though they may not say it publicly, they like the fact that their licensing business and their chip business are synergistic. And one man's synergy is another man's antitrust lawsuit.
Okay, so on that note, let me just wrap up Ceva here real quick
Sure.
with the actual numbers. Their market cap is $739 million. The revenue for the most recent quarter, Q4, was $21.2 million. For the year,
That was about and for the year, it's 22% growth. I remember that.
Yeah, very good.
70.
Yeah, so the $72.7 million for the year, and for the year they reported $13.1 million in profit, 61 cents a share. So let's shift a bit from the silicon space into the software space and take a quick look at New Relic, a substantially larger company. Their market cap is $1.85 billion. They reported some pretty good numbers financially, but the market pulled back a bit on them for a period there. What was involved with that?
Yeah, I think so. They put up about 43% growth in the quarter, year over year. I think that was down from kind of the high 40s and 50s that they had been putting up for a number of quarters. So there was a bit of that, just sort of that optical, it's decelerating, and if you straight line that over, just straight lines down to, the 30s, the 20s,
Right.
and you take, look at a lot of the sell side guys, Morgan Stanley, so forth, have them, doing 44% next year, but then decelerating to 28. I think that's kind of, I think that's kind of a, well, hell, I'll say it. It's a lazy assumption. There's a lot more opportunity here. People view New Relic, a lot of people mistakenly, in my opinion, view New Relic's solution, which is application performance management. You use their software to monitor your software, whatever software that you're running, and they give you, a lot of great granular detail about and timestamp detail about exactly what your software did and exactly where it did it and all that stuff. But they also correlate it to the business side, which is why most of the cutting edge guys like Uber and Atlassian and all these kind of next generation companies are using them not just for their IT department, their C-suite. uses kind of views it as a dashboard into their into the how well their business is doing, not how well their software is doing. Whereas most of the APM, application performance management tool companies, are still kind of like thought of as IT tools because that's what they are. What I love about New Relic is they saw the opportunity to take this IT tool and make it a much more strategic piece of software going forward. And if you think about software increase, people call it digital transformation. Don't particularly like that term, but certainly what we see is software substituting for labor in the means of production. And if that's the case, if software is increasingly substituting for labor in the means of production, well, you better you damn better monitor to your software, and so there's a business correlation. And really, the aha moment I had a couple of years ago was this gentleman was talking to me about how Uber executives were using New Relic, like the C-suite executives were using New Relic to get an insight, not how their software was operating necessarily, but how their business was operating. And so, I really think this is the kind of moment that, back in 2007, in a previous life, I put a company in portfolio called Salesforce.com, and we were the second. The place I was with was the second largest shareholder of Salesforce at the time, and it grew from that was a $4 billion market cap, and it grew to obviously Salesforce now is over a $50 billion market cap now. I see the same kind of potential here with New Relic, so we are excited, although there are of course risks as always, and they do have a lot of competitors like AppDynamics, which, by the way, when it got acquired by Cisco, did kind of give New Relic a little bit of a halo. So though it didn't do well after the quarter, the acquisition of AppDynamics did help the stock, and I think kind of continues, to have people think in the back of their mind, hey, maybe New Relic gets bought out too.
Right. I think that's certainly something that we've discussed a bit in the past in looking at it. Their revenues, by the way, $68.1 million for the fourth quarter. That was up from $63.4 in the prior quarter. And you're right, their revenue growth did slow slightly. Year over year, the revenue growth declined from 64.47% to 42.63. But when you're growing the way they are and with the potential, I'm less concerned about that.
Yeah, exactly. Everything after 40% is kind of a little bit of a dice roll in my view. And it was interesting because everybody had Salesforce.com modeled to decelerate from the 30s into the 20s and into the teens way back in 2009 and 2010. And guess what? They put up above 30% top line growth for, I think, all the way through 2014, if I remember correctly. So, now some of that was non-organic, but still the core business at Salesforce.com grew a lot faster for a lot longer than people thought.
Playing devil's advocate here,
Sure.
As I look at the revenue numbers, in 2014, the year-over-year revenue growth was 113%. 2015, the year-over-year revenue growth was 75%. So 2016, it was 64%, and as Fred alluded to, the most recent calendar year was 44%. So there has been a significant deceleration on the top line. Now, part of that is 4 or 5 years ago, the revenue numbers off a very low base. And, as we look at, kind of their opportunity going forward, they're projected to do roughly, in excess of $300 million in revenue this year, right?
That's their guidance, yeah.
How big do you think the market opportunity is? Because they have a market share.
See, that's what I think. See, that's what I'm excited about.
That's where the disconnect is right now, right?
Exactly, because people view them as an IT tool company, and they view them as APM. They view them as an APM, and they look at APM as sort of the way it has always been looked at historically, which is, like I said, an IT tool. When you're an IT tool, IT, right? You don't affect top line, right? So you're kind of a whiny complainer, So the guy who wants to buy your software is a whiny complainer who's a cost, who's basically a cost center. But New Relic is different. I mean, they really are different. They are actually enabling better top-line management and better management of the business, not just the IT department. So that's where I see the disconnect from myself. So,
would you say the same thing about AppDynamics?
No, actually, I would not. And now they have started to realize, and they've copycatted a little bit how much of his slideware, how much of it is not. And I think there's a little bit, that's not just slideware. I think AppDynamics is a bunch of smart guys too. But what they did is they looked back and said, we're going to take the large enterprise customers. That's not what New Relic did. People also, I think.
So with those large enterprise customers,
so let me
their business is not the software.
Right, not as much. That is exactly right. That is exactly the point. New Relic, and a lot of people say like New Relic, oh, they kind of concentrate on the SMB. No, they don't. That's a misnomer. Their customers are smaller, but their customers are very well funded. Their customers tend to be the SaaS providers, and the guys whose software is completely substitute for labor in the means of production, i.e., in Uber's case,
right.
Atlassian, and then we go on and on. A lot of the SaaS companies, I think the vast majority of the SaaS companies at least use New Relic in part. So I think the open-ended opportunity is much larger than just an IT tool, and yet, so if it's an IT tool, it would continue to decelerate all the way down to the teens, because once you've purchased it all, there's kind of saturation. Okay, you don't need it again, and so you see that with IT tools all the time. This is different. I really do believe this is different. Now, with regard to the revenue deceleration that they have seen so far, I believe it is, like you said, mostly a function of the
They're a victim of their own success, right?
Well, yeah, it's also the initial part of the adoption curve. You're going to get that really fast growth, and then you settle down into the 30s. And what determines how large an opportunity are is when you usually get into that between 40 to 25%. How long you stick there, and how long you can come up with new product ideas and new things to sell and new upgrades and all that. That's where the rubber meets the road. And I think with New Relic, there's a lot of things that they can do, and a lot of things they are doing to prepare themselves to continue to upsell their existing customer base and expand out. And so like I said, our expected return right now is a little less than 30%. Over 5 years for New Relic, which is one of the highest of any of the companies in our portfolio as well.
So one final question before we move on to Radcom here. From a revenue growth perspective, and I know we've kind of been dogging this a bit here, but it is an important point and an important metric.
No, absolutely, you have to get that right.
They're at the 42.63% year-over-year growth. At what point do you become concerned? When that growth declines to a certain point, where do you get concerned? Is that 30%? Is it 25%?
No. It's if in the next I would say 18 months you have a quarter where they're below 30% year-over-year growth, then maybe there are some issues. It doesn't necessarily mean the wheels have come off, because things can be fixed and so forth and so on. But yeah, that would be more rapid deceleration than I would expect.
Okay, very good. So moving on here to Radcom. Ceva and New Relic are members of our portfolio. Radcom, also a member of the Samadhi portfolio. They are in the 16 category, our high conviction category. They reported numbers on February 14th. They had market cap of 192 million. Their earnings, I thought, were in line with expectations for that. And we like Radcom's fundamental business. We think they suffer perhaps a bit from lumpy uptake on the part of their customers, but in their particular niche, selling to the large tier 1 carriers, there's a bit of that lumpiness to the revenue cycle.
Well, so they beat on the top line. I think the consensus was below 8 million, and they posted 8 million in top line growth, which was up almost in excess of 150% compared to last year. I think the stock actually sold off on the earnings release, and I think that was because the guidance that was given on the call at the midpoint implied the company was going to grow next year around 28%. The stock had beginning of the year was
a deceleration, right? Which would be a deceleration.
It would be a deceleration from 2016. That's right, because it was up in excess of 50% from 2015.
Right.
Largely driven by the 3-year contract announcement from AT&T. I mentioned AT&T because as part of the Q&A on the call, one of the analysts asked, what the management saw in terms of a percentage that AT&T would contribute next year, and they commented they expect AT&T to be 50% of revenue. So if you look at the low end of the 36 to 39 million that they guided for, that 18 million that they talked about would be 50% of revenue. And that implies that they expect on the low end to get an additional 18 million from existing business and new product wins. They actually talked about that number on the call. They're expecting 11 million from existing customers this year and 7 million from new product wins. So going into last year, that existing business was nowhere near 11 million.
Right.
So that number has significantly increased.
Right.
The contract from AT&T is new. That was not in place. That was obtained at the beginning of 2016. Right. So that's another new win. I believe that the management team is being a little bit conservative in their projections, as they should be, because without something being a signed order in the door, you can't really project.
It's tough. Yeah.
Based on the long sales cycle in their product area.
Right. What I like about these guys, though, I mean, like you said, like they don't have competition really for what they do. In network virtualization, particularly for the cellular networks and for the sort of the next gen network services. That's something that AT&T has kind of been on the forefront of, but all the carriers have to do it. Now, eventually, they're going to attract all our competitors, but I kind of also see them as a great acquisition target, because if you're, I don't know, Nokia, Cisco, any one of these, Amdocs, even on the software side, you look at Radcom and go, wow, yeah, all the carriers need what Radcom is offering, and we can pick up Radcom, for. What's the market cap now? Like 200 something million? I mean,
less than 200.
It's and a lot of that's like how much
192
net
million.
I hate to
They
sound.
got 45. They got 45. Well, 42 or 45 million in
net
cash on
yeah,
the
that's as far as if it's a broken record, but yeah, wow, that's like what 40% of their no, that's about 20. It's about a quarter, a little less than a quarter of their market cap is in net cash. I like their space too. What they're doing, network virtualization, is something that all of the carriers really have to invest in going forward now in order to operate with the agility that is required for business. Now, telecoms can't be the weird laggard where you order a T1 line. Remember, it takes a month and a half to get it or something. You can't do that anymore.
Right.
Well,
network function virtualization is the way to get there.
Yep, and it helps the customer base, the CSPs, monitor and allocate resources along to adequately address the customer needs. So, it fits right in line with where their customer base is evolving to. But we got into the name primarily because we knew they were going to be one of the key beneficiaries in that migration. Yeah. And nothing on the call yesterday contradicted that thesis. As a matter of fact, the management team spent a lot of time talking about how a lot of the hardware guys that they have historically competed against saw a lot of their spending go completely away in 2016. And so it's more of a timing issue. You're seeing their customer base kind of evolve and move to that NFV kind of opportunity, and they're getting away from hardware, which Radcom is not a part of, and moving kind of towards their solution. They've got 9 product trials that they're involved in, and 4 of them are kind of towards the latter stages. So we would expect
and
these
those
guys.
are probably tier 1 carriers, or
they've got
tier 1 or tier 2 carriers.
4 active trials with tier 1.
Yeah, if you're a small carrier, you're not going to be really you don't have to be as cutting edge, but
no, but even if they get one of those real active tier 1 trials, to pop. That makes it for them this year. That could be close to an AT&T equivalent from 2016.
Sure. Right.
Well, the guidance only assumes 1 contract win of the 4. And it assumes that will happen in the second half of the year.
That's pretty
If that happens a little earlier than that, or they get an additional one, it's all upside to the projected numbers.
Yep.
So let's move on here from Radcom up to one of the larger members of our portfolio, a member of the Samadhi 4, our highest conviction category, and that is Microsoft. Microsoft, who recently reported, they are pretty much they dwarf most or many of the other players in our portfolio here. Their market cap is $498 billion. They had a good quarter, and actually, I've got to say, one of the things that I like about Microsoft is the shift that management, has been executing on, for the last 12 months. I mean, they really are, in my opinion, very well positioned. They understand the value of their software. They understand how to leverage it, and they seem to be firing on all cylinders, moving, well past the Ballmer era.
Yeah, I think Satya Nadella is brilliant. I think he's done a fantastic job. Ballmer always wanted to attach. He was always sort of looking. It always appeared to me that he was looking in the rearview mirror, always trying to leverage the Office, leverage Windows, and not look forward. And I think what this Microsoft is doing is really looking forward and leveraging Office and Office in particular, but doing it, as a way to sell Office as a cloud service,
right.
And everything as a cloud service. And Azure has just done gangbusters, and now Microsoft is basically the second largest enterprise cloud provider, second only to Amazon. And obviously we know and love that business with its great operating margin and operating margin expansion potential, and that should be the same true for Microsoft as it has been for Amazon, if not more.
It's interesting that we're so positive on Microsoft here right now, because a couple of years ago I was at my former employer. I was actually very adamantly against Microsoft, but I noticed a key fundamental change, and I don't know if it was Nadella that did it, but Microsoft in their annual letter commented about themselves as being a service company, right? As opposed to a product company.
Yeah, they have adopted the as a service model very well.
Yeah, and that is not only a different sort of business model, it's a different production model. It's DevOps. It's not just development. It's not sitting there for 3 years. With 1,000 programmers, and then at the end of the 3 years, ta-da, we're done. Here's our big, bloated piece of software that we're going to have our salespeople sell. DevOps is much more iterative. You have a service, it does something, and then you continually, sort of update it and operate it, and there's a feedback loop between the developers and the runners of the software. That's great. That's how you do cloud. That's how you do SaaS. But that requires a very different mindset, organizational structure, leadership, incentives. It really, and kudos to, if it's Nadella, you're right, or if it's a combination of other people, they have really made that turn, and they I think in the enterprise are going to be a force to be reckoned with, and of course they still, even though Windows is going to decline, we know that. But it's still ridiculously profitable. So they've got this great sort of annuity stream for many, 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 many years, which they can use to fund a lot of their other stuff. And so,
acquisitions of LinkedIn.
Acquisitions of LinkedIn. I mean, I think that's that whole. I thought it was a little expensive, but nevertheless, it does hold a lot of potential synergy.
Well, and quite frankly, you have to give them credit for their transition to create the infrastructure as a service product offering. They did that well before a lot of peers did, Oracle and Google included. Well, I shouldn't say Google, but look,
Google's always been weird about that. They tried it before, but they never really got serious about it. Yeah, that's true.
But that was a significant lost opportunity by a lot of their peers.
I agree.
And they
That's true.
Clearly, in the most recent quarter, Microsoft does kind of report funny math, but their commercial cloud business is growing at a run rate of $14 billion. That's actually close. That's actually close to AWS. Now it's not an apples to apples comparison, but it's still pretty. It's very impressive.
It is impressive.
It's very impressive, and that's clearly an area that's going to continue to grow over the next 3 to 5 years.
And like I said, and that's great. And probably has. I don't know what the operating margin on that business is now, but we know how it works. We know that with that kind of business, that cloud business. There's just a tremendous amount of operating leverage potential. You can go from the teens, boom, to the 30s, in a matter of years in terms of operating margin. So, it's funny to think about Microsoft being even more profitable, on a, relative to its revenue than it already is. But that's, I think, what's quite possible.
Yeah, there's an interesting comparison there. I mean, we're long on Amazon. Primarily because of AWS,
right?
And
exclusively,
pretty much, almost exclusively, yeah. And I see the same things starting to take shape with Microsoft. I mean, they're a very different beast, but their cloud offerings, they are becoming a critical component of their revenue and their earnings.
And they're compelling. Like, customers really like them. Customers, like, at first, Azure seemed to be kind of a mess for a couple of years because they were trying to support all these different languages and all this. And they really, and I got to give them a lot of credit. They really streamlined that service. I guess streamline is probably the best, the best word for it, so that they can offer the customer some sort of clear menu of things to actually buy, and at attractive prices.
Let's be clear. There's still a long way that they can go to improve their customer service offering with Azure. After speaking with an industry analyst earlier in the week, she was pointing out a lot of weaknesses that they have. Right, but they're doing the right things to address them. Number one, and at the end of the day, they're also benefiting from some potential customers not wanting to be a part of the Amazon cloud, whether that be from competitive purposes or other reasons.
Just to keep there's always that sort of reversion to the mean, hey, let's try to keep two vendors in the game here.
That's right.
There's always that sort of desire to do that. And also for load balancing and security purposes. I mean, if you're a Fortune 500 company, you might very well want to have half of your stuff on AWS and half of your stuff on Azure if you want to go full public cloud.
There's a lot of value in sort of the technical equivalent of biodiversity, the techno-diversity.
Right.
Making
Supplier
sure that you're not
diversity is a key thing.
making sure you're not too locked down there. So let's wrap up here with a company that has not yet reported earnings. They'll be reporting in a couple of months here, and that is BlackBerry. BlackBerry has one of those odd fiscal year cycles here, but I want to bring them up because they're at the point, and BlackBerry,
March, right?
they are in our, yes, I believe so. They are in our portfolio. We are long BlackBerry primarily because they've done something that we've thought they should have done for quite a while. They have transitioned completely out of the hardware business. They are now a software play, and they're doing some interesting things, in that move, particularly around licensing their software. And they just came out with a new licensing package targeted at their Messenger application for developers to kind of open that up to see if there aren't some things in their legacy portfolio that they can better leverage moving forward here. They also, by the way, they just lodged a patent infringement lawsuit against Nokia. I don't know all the details of that there, but
I saw that coming. So
Yeah.
one of the reasons we got excited about BlackBerry was the plan to transition to complete software. And they had a lot of software assets. They had their own security software and sort of some mobile device management applications and software. And then they bought Good Technologies, which gave them even more of the same kind of stuff. And now, and that's and that part of the business has actually grown quite well. It's grown, 25 to 30%, and it's still on that run rate. Obviously, they are losing this huge top line, chunk of revenue that goes away. But then it goes away, but no profits disappear because they were losing money on the hardware. And so it's like, why do you want to be in that business? So I think it's a very new company. The good news is, and they got a lot of net cash on the balance sheet. I think it's almost $1 billion net cash or something to that effect. I mean, it's a fair amount. It's probably 15 to 20% of their market cap at least. And then they've got this huge IP portfolio of patents. They've been doing this stuff for a long time. People remember, like, BlackBerry was around when cellular networks were old, when they were creaky and tough to send data over. So they got a lot of that of core patents, and they said so. They was like, we're going to start to enforce them. We're going to start to use it, and I think we're seeing this now. And it's going to be very interesting to see if they can get any money out of Nokia, or maybe force Nokia into some sort of exchange deal or something like that. But the last thing I'll say about BlackBerry is, as a stock, the good news about it is that everybody, like all of the generalists out there who haven't been following it, is like, oh, BlackBerry, that's dead, right? Like, there's kind of that out of sight, out of mind. The last time I thought about BlackBerry was when I saw them drop below 5% of the smartphone, market share, and I never paid attention to them again. That's where you can honestly find those rare tech value plays, and that's what I think BlackBerry is. In fact, I think it's even better than a value play. I think it's actually it's definitely a value play with the potential of being a revival.
I think it's funny. Nothing lasts forever. I mean, we actually were interested or attracted to the name because they were getting out of the phone business. Years ago, that was one of the key headlines that people thought about when they thought about BlackBerry.
That's right.
There was actually an article that came out on
That's funny.
Business Insider today saying that BlackBerry has less than 1% of the mobile phone market. We're glad they're out of that business. We see a lot of value in their IP portfolio. We like the cash on the balance sheet, reduces risk, and we like the areas that they're going into. So it's kind of a counterintuitive kind of play.
It is. It is indeed.
We also back at the end of December, we listed BlackBerry as one of our top 10 acquisition picks.
Right.
For 2017.
And a lot of it has to do with that IP portfolio. It's almost 2,000 patents.
Exactly
there.
there. I mean, I could actually see a private equity firm stepping in.
Yeah.
An organization that has the ability to really leverage that, across some of their portfolio companies, but then also monetize it perhaps a bit more aggressively.
Yeah, no, that's a good point. That's a very good point.
Would they ever sell off some of the patents, like some of these patent trolls?
Sure, why not? I mean, I just think that the 2000, I think they're probably, I don't know this, but it appears to me that they are probably willing to consider all kinds of different monetization strategies. But I just think that's one thing that has just gone overlooked is the fact that they have, it's not just 2,000 patents. It's a lot of core fundamental patents that surround data and messaging and how to operate messaging over SMS and over email, and there's a lot of that stuff that's still, it's still a little kludgy when you get inside of a telco network that is valuable to a lot of different kinds of providers, I would think.
Got a question. We really like the Good Technologies acquisition. What other areas do you think they should focus on in terms of growth?
So I think this is and it appears that they're at least, in terms of slideware, going in the right direction, right? Execution obviously is a bit of a test, but one of the things is to move from device security as a standalone sort of application or mindset to more holistic device, mobile device, enterprise device, and enterprise application development and management. They could get into the mobile app development tool space, which, hooks right back into security because you got to check for, backdoors in the code and all of that kind of stuff. I mean, there's a lot of areas for growth here from where they are, but it does kind of lend itself a little bit more toward a suite-ish sort of a position. If you're selling an enterprise is like, okay, great, that's security taken care of. How about how about asset management? How about application mobility? And how about application development? Blah blah blah. How about application performance monitoring for mobile applications? All of those different things are all should all be tied in eventually. So there is more land to grab. I think that BlackBerry, and I think BlackBerry gets that. But one step at a time, I suppose.
As we discussed BlackBerry, it seems like it would be the ideal kind of candidate for an activist shareholder to come in and create a lot of pressure to have these guys kind of try to grow the business with all the assets that they have.
Yeah, I think they're going to get at least 2 quarters before somebody starts sniffing around for that. And the reason I say that is because I think the most recent quarter was the last quarter that has any actual hardware sales.
Hardware, yeah.
So, I think people are going to kind of look at them for maybe 2 quarters to see the progress of this new reborn software
just to make sure that the wheels are on the vehicle and they're aligned in the right direction.
Well, yeah, but also just okay, so give it a chance. Go ahead and take a stake, give it a chance, and if it appears that they are under leveraging their assets and not doing the right strategic moves, then maybe I think an activist guy could could step in a couple of quarters, particularly if the price is exactly where it is now.
I'm thinking about Symantec. It was actually one of the better performers last year.
Yeah.
And part of that was because of a lot of the moves they made strategically, right?
That's right.
I mean, they went out and made some pretty interesting acquisitions.
They did. They really did, actually.
To grow the top line. I mean, BlackBerry should be this year's candidate to do the same thing.
And they have the cash.
Yep.
So
Yeah, I like that. Blackberry. This year's Symantec. So with that, let's wrap up this edition of the Samadhi Brief. I would invite our listeners to subscribe to our mailing list. You can do that at samadhipartners.com, and also to follow us on Seeking Alpha. That's seekingalpha.com/author/Samadhi-partners. John, Guaylon, thank you very much.
Thanks, Fred.
Here's to the next edition.
good stuff. Thank you.